Roll. Let's talk about what's happening in the mortgage markets this week. Let's talk about what happened last week. PCE, personal consumption expenditures, showed that the headline number rose 0.155 in July, so rounded up to 0.02 or to 0.2, I'm sorry, which was slightly below what was expected. So what that means is year over year inflation is at about 2.5%, which is a little bit better than what they were anticipating. So that's why you didn't see the markets really go up or go down. Literally 3 days in a row, the 10-year Treasury was down one or two, and the mortgage-backed securities were up one or two. So traded within a ridiculously tight range. What's important, though, is that the core rate, that strips out food and energy costs, and it's the main focus of the Fed. Never understood why that's why they like that one, because, well, isn't food and energy costs almost everything? So year over year, inflation remained at 2.6%. Some were looking for 2.7, but the monthly core reading was very good at 0.161. And when annualized, that actually comes out to 1.93, which is below the Fed's target. What does all that mean for us? It's a lot of the geek speak, right? It means that inflation's moderating and it's heading into the Fed's target despite good monthly progress and year over year progress because of the low replacement values from last year. Hey, August from 2023 was very low, but we should be able to make some good progress when we get the data for September. And again, everybody's is pricing in a 25 basis point cut in the Fed fund rates, which again, psychologically, it has an impact on the mortgage rates. But what you have to understand, folks, Fed fund rates is the money that banks lend each other overnight, right? And so that has a big impact on your car loans, your credit cards. But other than psychologically, not very much for mortgage rates. But I do believe that you'll see them going down. I would say substantially. At least I think by the end of the year, we'll be under 6. Now, the other good news that came out last year is existing home sales snapped their 4-month losing streak. Home sales rose 1.3 in July to 3.95, which was in line with what the market was looking for. Sales were down 2.5% year over year. Now, the median home price for existing home sales sits at $423,000. So that's up about 4.2 year over year, 1.3 month over month. But each month you're seeing more and more revisions on the annual sales pace. We started out in July at 4.05. Now we're down to 3.95. Inventory creeped up a little bit. But again, folks, the average market time is 24 days, right? So we need to bear that in mind. So overall, the market is still stagnant. We do need to see some things happen with interest rates before we break off and see a big buyer and seller market. Certainly more buyers will come into the market when that happens, but I also believe that more sellers will also come into the market. So